Greetings. Today is Monday, June 3rd, 2024, and this is our monthly market monologue where we will take a look at the stock market's performance for the month of May. The plan at the moment is later this week I will shoot a second part of the video where we will look at some of the economic data points, some of which I'm a little concerned about. That said, if you're not familiar with my firm, Hicks Associates Wealth Management serves individuals and families by serving as their chief investment officer. You can certainly check out our website, hicks-associates.com, for more details. In short, I would tell you that our active management approach is designed to minimize drawdowns while capturing upside momentum. If you want to learn more, just click on the schedule a call or begin here. Click on one of those blue buttons on our website. Having said that, on the screen right now is the monthly candle chart that I showed in last Friday's video, where we discussed the fact that the S&P 500 was undergoing a key month-end test. We then looked briefly at the daily candle chart with the same comment that the market was experiencing a little bit of a month-end test. That's what the chart looked like when I shot the video. Here's the 5-minute chart of how the day played out. You recall that in that video from Friday, I said I would love to see a afternoon rally to close the month strong. And on the screen now is this blue rectangular box that is the day's trading session from Friday. And you can see right at 12, the train came in on schedule and we had a massive day-end rally to close the month off pretty strong, resulting in a nice candle for the last trading session of the day, putting us back above those April highs. So we would certainly say that the month-end test was passed. So on the screen right now is the monthly candle chart. That is the final candle for the month of May. And you can see overall that the month of May ended up being a pretty strong month. Definitely came off of the highs, but the fact that we closed so strongly on Friday is certainly a good sign. If, however, we look at the S&P 500 equal weight ETF RSP, we don't see quite the same amount of strength. That theme continues to be the case, where again we had a bit of a strong rally on Friday, but not quite enough. If we look at the NASDAQ, we can see the NASDAQ closed out even stronger. We are starting to see some weakness in the tech sector. I don't know that I'll go into a ton of detail on that, but in particular, the NASDAQ closed out the month of May in a pretty strong fashion. Next up is the Russell 3000. I mentioned a minute ago that we are continuing to see thin participation. Well, what I'm about to show you is some signs that is beginning to change. These are encouraging signs. Remember, the Russell 3000 is a better or certainly a broader measure of the overall U.S. stock market. As we've discussed, the S&P 500 is the largest 500 stocks in the U.S. as measured by Standard & Poor's, but it's cap weighted. It's very skewed. So the Russell 3000, while also cap weighted, it has a lot more stocks in it. And so when I'm looking at breadth or how many stocks are participating in the rally, I tend to look at the Russell 3000 as it's going to include the big cap, the large cap, or the small cap. I'm looking at both of those. So when we look at the monthly candle chart for the Russell 3000, again, we see a very similar picture where it rallied very nicely on Friday, closing above those April highs, which in our opinion is very key. However, if we dive a little bit deeper underneath the surface, let's look at advancing versus declining stocks. Inside of this Russell 3000, the green bars represent advancing stocks on any given day, and the red bars represent declining stocks. And as just about always, we want to key our eye to the right-hand side of the screen. You can see that very strong candle in the Russell 3000 on Friday. But look at the last 2 days of the month of May. A lot more advancing stocks than declining stocks. So we would say that is a very good sign. Now, let's take it one step further. And now we will look at what we refer to as the advanced decline line. So in the top pane is IWV, the Russell 3000. In the bottom pane, we have the advanced decline line for the Russell 3000. So all that bottom pane is doing is taking This data, the bottom two panes, the advancing and the green bars and the red bars, it's taking that data and it's plotting it as a single line, advancing stocks minus declining stocks. And what I want to point out here is look at this peak from, looks like that is April. And that is, again, these April highs in the Russell 3000. And you can see that the Russell 3000 itself closed again at those highs, but look at the advanced decline line. It actually advanced even further. So it's a little too soon for us to really declare that as a bullish divergence, but that is certainly good news. So for the last couple of years, we've talked a lot about the Magnificent Seven, and I'd like to show you a divergence that is developing. And we could take this as either really good news or really bad news, depending upon your perspective. I'm just going to demonstrate that it is what it is. But on the screen right now, we have a chart for the Magnificent Seven. It's basically an equal weighted version, putting all those 7 stocks into one ticker symbol, and there you have the Magnificent Seven. However, let's change the data just a little bit and show you the Magnificent Seven minus NVIDIA. So if we take NVIDIA out of the Magnificent Seven, you can see what a difference NVIDIA has been making. If we then plot the two side by side or on the same chart, you can see that the Magnificent Seven with NVIDIA year to date significantly outperforming the Magnificent Seven without NVIDIA. And the last chart that I want to show you for today before wrapping up is an update. We've talked a little bit about this and how we might want to consider looking at an investment portfolio a little bit differently than we may have done historically. Historically, you may have been told that you should weight your portfolio 60-40 or 50-50 or 70-30. In other words, some allocation to equities and some allocation to bonds. Bonds continue to struggle, and in a 60-40 allocation, the 40 is represented by bonds in a traditional weighting. Well, you can see on the right-hand side, the S&P 500 through Friday is up about 11.5. The equal weight version of the S&P 500 is up only 5%. The 60-40 portion, if you had a 60-40 model portfolio, your portfolio would be up about 1%. And then you've got aggregate bond index, or ETF, is -2.25%. And then you've got long-term bonds, -8% year to date. So I continue to hammer on the theme that if you are relying on bonds in your portfolio to act as a stabilizer, you might want to rethink that. If you are managing money yourself, and you want to talk to me or Paul about how we might be able to serve you and how we do things a little bit differently, by all means, again, visit us at hicks-associates.com. Hit one of those blue buttons to schedule a call with us, and we'll be happy to sit down and chat and tell you a little bit about a little more about how we manage money. Again, our management approach is to minimize drawdowns while still trying to capture that upside momentum. Until next time, I will shoot a second video later this week. We'll talk a little bit about economics, but until then, thanks for watching. We'll talk to you soon.